Hello everyone and welcome to Managerial Accounting 1B. So in this video we're going to start discussing managerial accounting and we'll just have an introduction. And remember, this course is just a continuation to 1A, which is the financial accounting. So we're going to learn about the definition of managerial accounting, how it's different from financial accounting. We're also going to learn a few terminologies or terms that are used typically in managerial accounting, and this is going to serve us well in the future chapters. So let's get started, and the first thing we need to learn about is the definition of managerial accounting. So sometimes we call it management accounting, and it's typically the process of developing information and management tools to achieve an organizational objectives. So unlike financial accounting, where financial accounting serves so many different parties or stakeholders, external and internal, managerial accounting is only focused towards management and employees within the company. External parties usually don't get involved with management accounting. So again, I just want to stress on the importance that we develop information and management tools to help managers and employees achieve the organizational objectives. That's the main purpose. The management process consists of few functions, and there are four basic functions that we're going to discuss in the next slide. So we have the strategic planning, we have measurement, we have evaluation, and we have control. In strategic planning, the word strategic typically is long-term, so something between 5 to 10 years. This is what we think when we use the word strategic. So strategic planning is where a management process begins to develop long-term objectives and normally involves a time horizon of 5 to 10 years. So please keep this in mind whenever we're saying about, or whenever we're using the term strategic, we are referring to long-term plan. So we here have the strategic plan, so it's something between 5 to 10 years. That's a typical scenario for a strategic plan. Operational plan develops short-term actions for managing the day-to-day operations of the company, and that's different from strategic planning. So when we say strategic planning, that's something that's usually long-term vision. Operational planning, that's more on the day-to-day operations of the business. The other function is measurement, which is the process where managers develop and agree upon performance matrices on how well the company is achieving its objectives. So we set a plan, but we want to know how well are we in achieving this plan, and that would happen by measuring our performance. So measurement is an important process in any kind of managerial role because we want to know where we stand. It doesn't make sense to just operate and we don't know if what we're doing is really good, successful or not. Then we have to go through the evaluation function, and it's the process by which management monitors operations by comparing actual and expected results. So now we set the plan, we made our measurements, and then we see whether we are actually achieving what we expected or not. And that's what we do in evaluation. Another very important function is control. So control is the process by which management takes action to encourage specific behaviors or outcomes. And again, control is very important because it also prevents any kind of wrongdoing or wastes from happening in the operations of the business. So in this chart here, we just have an idea about how the cost, or developing the cost information, and how we develop management tools. So this just gives us a structure for the different chapters that we're going to cover. And as you can see, there are things like the costing system, the overhead allocation, the supporting costs. All of these topics are going to be covered in different chapters. We're not going to cover everything. I think we're skipping chapter 19 about joint cost, and a few of the last chapters like activity analysis, the balance scorecard, and corporate social responsibility. I think this is going to be discussed in future topics, but for now I think we're covering most of these topics, and that's part of achieving the four functions or managerial functions related to strategic planning, measurement, evaluation, and control. So now let's talk about developing management tools. So managerial accounting develops a variety of tools for management to use in analyzing information and making decisions. And this includes things like cost volume profit analysis for determining the sales necessary to break even or earn a target profit, And we'll have a separate chapter talking about that. Same thing for budgeting, for resource planning. And again, we need to have a budget, how we create a budget so we can use our resources in a wise and a smart way. Also, decentralization for assessing operations that are centralized or distributed throughout the company. Differential analysis for comparing the profitability of various options. And then finally, capital investment analysis for use in decision or in deciding among long-term assets to purchase. And that's very important because we want to know whether our investment is actually doing its purpose or not. So capital investment analysis is very important as a way of deciding the long-term options for the use of our assets. Now let's compare financial statement, financial accounting and managerial accounting. We want to see whether there's major differences or not. And as I mentioned before, for the uses of information, you can see that for financial statements, which is the product of financial accounting, this can be used for external use as in company management. But managerial accounting only provides managerial accounting reports, and that's only used by management. You don't expect external users to rely on your managerial accounting reports. And even as a company manager, I really don't want to share my managerial accounting reports with external users. So it's typically used among management and some high-level employees. So just a quick refresher, if you can remember, the financial statements, we have the statement, the balance sheet, income statement, statement of stockholders' equity, the statement of cash flows. These are the typical examples for the financial statements. For managerial accounting reports, we'll see reports like production reports, activity analysis, budget reports. All of these can be good examples for managerial accounting reports that would be used among managers. So the nature of the financial statements, as we covered in financial accounting courses, is very objective. Usually it's based on facts. We have a few estimates here and there, but it's very objective. For managerial accounting reports, it's a mix of objective and subjective information. So expect that you'll see the more subjective information provided through these managerial accounting reports. Again, if we look at the financial statements one more time, the guidelines for preparation is generally accepted accounting principles. So it's prepared based on GAAP. The managerial accounting reports, they are prepared based on management needs. And again, needs vary. So you can see that in some cases a manager would need a specific report, and in managerial accounting we can help in preparing these different kind of reports. The timelines of reporting for financial statements, it's prepared at fixed intervals. In managerial accounting reports, it's prepared at fixed intervals and sometimes as needed. So if I need to prepare like a mini budget for a smaller project and the manager can get to make a quick decision, then this is something that's prepared based on needs. The focus of reporting, again, for the financial statements is the company as a whole. For managerial accounting is the company as a whole or a specific segment. Sometimes it's just a specific subsidiary or branch or department within the business that needs this kind of managerial accounting report. There are many considerations and choices in developing costing information, and that's an important part of managerial accounting, is to develop costing information. So things like, or questions like, what cost system should we use to record and report the cost of a product? How do we allocate overhead costs, such as equipment depreciation to different products? And I hope you still remember the idea of depreciation from financial accounting, where we allocate the cost of an asset over its useful life. How do we allocate support department cost, such as factory janitorial cost to products, which is in many cases it's very hard to allocate. How do we allocate joint manufacturing cost to products? How do we report fixed production costs, such as factory supervisors' salaries? How do we determine and report variances or differences between actual and planned cost? So all of these things would be answered using costing information. So let's think about management accounting within the organization. So most companies, they are organized in terms of either vertical or horizontal representation. So Let's see the differences. And remember, vertical it goes that way. So verticals are sometimes referred to as business units because they are often structured as separate businesses within the parent company. Verticals develop products that are sold directly to customers. On the other side, we have horizontals. These are departments within the company that are not responsible for developing products. Horizontals provide services to the various verticals and other horizontals. So the key thing here, verticals, they develop new products, new services. Each one is responsible for developing products that are sold directly to customers. Horizontals, no, this is supporting to the verticals. So here we have an example of presentation. This is just a partial organization chart for the company called McAfee, which is the antivirus kind of thing. So we have the CEO, and here we have the executive vice president or the CFO. So for the CEO of the company or the chief executive officer, we have the executive vice president for consumer business unit. We have the executive vice president for enterprise business unit, and these are considered to be verticals, okay, because they are the ones who deal directly with the customers. And then we have assistants to these, and these here we have the sales and marketing executives, we have the chief financial officer, we have the chief technology office, we have the general counsel, and we have the human resources. Again, you can see nothing here provide a new product, okay? They don't deal directly with the customer, and that's why they're considered to be horizontal. If you look at the CFO, or the Chief Financial Officer, we have the Vice President for Finance for Consumer, for Enterprise, and these are considered to be supporting verticals, or they support verticals. For Marketing and Consolidations, or Finance Consolidations, these are horizontals. And then we have something like the Chief Accounting Office, that's considered to be a support, or it supports the corporate. So here we can see an example for what we mean by vertical and horizontal. But the key thing I want you to remember, for vertical, that deals directly with the customer or the product or service provided to the customer. Horizontals, they are the departments or the divisions or the units that would support the verticals. Now let's talk about manufacturing operations, and I think manufacturing operations is the most intense kind of operations compared to services and retail. Because in manufacturing you deal with everything. You deal with raw material, you bring it, you develop a product, and then you sell it maybe later on to retailers. So I think it's comprehensive because it covers everything that you will see in other retail and manufacturing services. So just in general, I want you to know that operations of the business can be classified as one of three things. Either service, and these are, they just provide a service with no product, like an accountant, for example, or a consultant. They just provide a service here. And then retail, this is a business where they buy a product and sell it as is, without any form of transformation. And then manufacturing, these are the ones who would buy raw material, and then they are going to transform it in the form of a product, and then they sell it typically to retailers. In some cases, in very few cases, they actually sell it directly to the customer. So most of the managerial accounting concepts that apply to manufacturing businesses also apply to service and retail businesses. And that's good, because if we understand the manufacturing businesses or the managerial accounting concept for managerial businesses, that would make it easy for us to apply it on service and retail businesses. In this chapter, we're going to use an example of a manufacturing operation for a company that manufactures guitars. And we'll use that as an example to follow the concept. And you can see here, like we're going to get to know the material used in guitars, like the wood, the strings, what they call it, the bridge, and then the cutting of the guitar, the assembly, and then the final product or the finished product. One of the important concepts in management accounting or managerial accounting is direct and indirect cost, and we need to learn that from the very beginning, and that's why it's covered in the very first chapters in management accounting. And this is direct cost versus indirect cost. We want to know what's the difference between direct and indirect cost. But before we go there, let's understand what's meant by cost. So cost is a sacrifice made to obtain some benefit, and in managerial accounting, costs are often assigned to cost objects. So we have a cost object, and based on that, we will know what is the sacrifice we're making. So a cost object can be anything to which costs are assigned and will vary depending upon the decision-making needs of management. I think all of this would be good once we use examples, and we'll do that in the next slides. But since we're talking about cost, let's differentiate between what we mean by direct cost and indirect cost. A direct cost are identified with and can be traced to a cost object. For example, let's say I'm a manufacturer of tables, wood tables. So the wood used in the manufacturing of the tables is considered to be a direct cost. If you think about the carpenter who's working in manufacturing the table, the cost incurred or the hour spent and we charge or we pay to that carpenter is considered to be a direct cost, because the more tables we produce, the more hours that carpenter is going to be working in manufacturing the table. On the other side, we have indirect cost, and these are not identified with or traced to a cost object. So let's say we have this kind of table manufacturing business, and for the warehouse we need to have insurance. Do you think this insurance can be allocated to each table? Sometimes I feel it's hard because it depends on how many tables we're manufacturing, but at the same time we're always paying almost the same amount of insurance whether we are producing 100 tables or 200 tables. So we call that indirect cost. But it's a cost of having a warehouse. We still have to incur this kind of cost of insurance. So whether we like it or not, we have to insure our business. And that could be called indirect cost. So think about that. We need to identify the cost object, and in our case here, the cost object is the guitar. We need to determine if the cost can be identified with and traced to the cost object. If it's traceable, things like wood and strings and things like that, we refer to the cost as direct cost. If it's not traceable, things like, again, insurance, maybe management salaries, this is considered to be indirect cost. So again, based on the traceability of the cost, we can decide whether it's direct cost versus indirect. So in our example here, there are three things that we have to think about when we are considering manufacturing cost. And here we're using the example for this company called Legend Guitars. And we have to think about the direct material, the direct labor, and the factory overhead. These are the three main types of cost that are going to be used in our analysis. So let's start with the direct material cost. And that's part of the direct cost. So manufacturing products begin with raw material that are converted into finished products. To be classified as direct material cost, the cost must be both of the following. It has to be an integral part of the finished product, things like wood. It's an important part of the guitar. And it has to be a significant portion of the total cost of the product. It has to be something significant. If you think about it, the cost of the wood may be like 30 or 40% of the total cost of the guitar. But let's say it's something like 0.5% or 1%. In this case, we cannot really classify it as a direct material cost. So something, let's say the glue used. If the glue is only 1% or less of the total cost, then we don't consider that to be a direct material cost. So example of direct material costs include things like the cost of wood used in producing a guitar, which is for the example that we have been using. Let's say we're talking about a company that manufactures televisions, so the cost of the electronic components. If we are a microcomputer chips manufacturing company, then the silicon wafers, then that's going to be the material or the direct material cost. For automobiles, the tires, that's a direct material cost because every single car would have 4 or 5 tires depending on the spare tire. Then we have the direct labor cost. And most manufacturing processes use employees to convert material into finished products. Usually we have the material, and then we have employees or workers that would help us put the material together. So the cost of employees or employee wages, that is also an integral part of the finished product, is classified as direct labor cost. Two criteria again that should be met: an integral part of the finished product, a significant portion of the total cost. Same idea like direct material. Examples would be the wages of employees who cut the guitars out of raw lumber and assemble them, the mechanics in an automobile shop or repairing shop, the wages for assembling a laptop computer. All of these are considered to be examples for direct labor cost. For factory overhead, costs other than direct material cost and direct labor are classified as factory overhead. Sometimes we call them the manufacturing overhead or factory burden. All factory overhead costs are indirect costs. Remember that. All factory overhead costs are considered to be indirect cost of the product. Some factory overhead costs include heating and lighting the factory, the lighting that we have in the warehouse or maybe in the offices, repairing and maintenance of the equipment, property taxes that we pay for the factory building and land, insurance, as I mentioned before, depreciation of the plant and equipment. All of these are considered to be overhead. And again, remember that these are considered to be indirect cost. So let's try a knowledge check activity right now to see whether we are getting the idea of what's considered to be an overhead. So for manufacturing, which of the following would be considered a factory overhead cost? Is it the hourly wage paid to assembly workers? Again, no, that's a direct cost. That's part of the direct labor cost. How about cost of flour in a cookie factory? Again, that's direct material cost. Electricity cost in a furniture manufacturing facility? Yes, I think that tends to be an overhead cost. And one thing I can say, it's an indirect. We cannot really trace how much is the electricity used to each piece of furniture that we manufacture. How about a hairstylist wage at a mall hair salon? In that case, again, that's a direct labor cost. So the right answer in this case would be C. And as you can see here, the costs other than direct material cost and direct labor cost that are incurred in the manufacturing process, such as electricity cost, are considered a factory overhead cost. So let's stop here at this and we'll continue in the next video the discussion, and we'll talk about something called prime cost and conversion cost. All right, thank you for watching.